Good afternoon, and again, thanks to National Bank for inviting me back. Allow me to begin with a bit of a personal remark before I get to the issue at hand. I was reminded when Boris talked about 29 years of Dubrovnik Conference. I first came to Dubrovnik 33 years ago as an IMF-appointed advisor to the last federal prime minister of Yugoslavia, as a part of the international community's last futile attempt of preventing a breakup. When I left Dubrovnik, the Yugoslav army had already taken position in the hills, and the shelling started soon thereafter. Back at the IMF, I continued to work on the region, and not least Croatia, for many years. I have followed close up what has been an exceptionally successful process of nation building, in what, from the perspective of history, clearly only is a blink of an eye. This has now enabled Croatia to join the euro, and really heartfelt congratulations. Good for Croatia, good for the euro area, and well done, Boris, and your team. Okay, the subject is policies under high inflation. The discussion so far of monetary and fiscal policies has so far focused mostly on sort of the immediate future. I want to be sure that we don't forget some of the fundamental political economy constraints limiting policies, not least in the euro area. So, inflation is running at levels not seen for many decades, triggered by exogenous shock, COVID-19, Chinese lockdown mistakes, Putin's war. Policy mistakes have compounded the problem. The fiscal relaxation was excessive. This was certainly the case in the US. I would argue it was also the case in Europe. I would also agree with those who argue that the monetary relaxation was excessive. But after a long career in the crisis management business, I will not join the Monday morning quarterbacks who were not at the table and who, with the benefit of hindsight, criticized policymakers for mistakes made under the extreme uncertainty associated with an aggressive global pandemic. More importantly, if we focus too much on recent policy mistakes, we risk overlooking a much more serious issue, in my view. As always, the main problem is not what we do in response to crisis. The main problem is what we don't do during the subsequent recovery. The failure of politicians to undertake reforms during good years is, of course, well known. In many countries right now, the failure to advance the social security reforms needed to cope with aging population will undoubtedly constrain the public sector's ability to deal with, like, say, climate problems and evolving security constraints. But my question to you is whether the long-standing problems of fiscal policy complacency has increasingly been compounded by a similar complacency among central bankers. My almost 40 years in policymaking coincided with the liberalizations and privatization of the Reagan-Thatcher era, the weakening of labor unions, and above all, of course, the dramatic structural changes associated with globalization. But they have also coincided with the system becoming excessively risk-prone because big financial investors increasingly expected to be bailed out by monetary policy. First, as you remember, it was the emergence of the Greenspan put in the years of irrational exuberance. Then it was the massive monetary injections to quantitative easing following the global financial crisis, even as economies rebounded robustly. I wonder sometimes whether economic historians will be somewhat unkind to the current generation of central bankers. Will the long period of strong downward pressures on prices associated with globalization be seen as a period when central banks became increasingly, if you allow me, captured by markets? On the eve of the COVID crisis, the Fed's balance sheet was almost 10 times larger than it was on the eve of the previous crisis, the global financial crisis, because of the failure to normalize monetary policy during the recovery. Central bankers will, of course, I'm sure, argue that, that inflation was running dangerously low, especially after the global financial crisis, and that they were merely fulfilling their mandate by stepping on the monetary accelerator. One problem is, of course, that our understanding of the inflationary process was quite poor during these years and remains so, leading us to persistently overestimate inflationary pressures in the run-up to the COVID crisis. We had a broad understanding of the factors at play, but exactly how globalization and other structural changes which altering the Phillips curve was somewhat of a black box. Despite this, central banks continued the highly accommodating monetary policy, even as output gaps were turning positive and fiscal deficits were shooting up. They dismissed warnings about excessive risk-taking and leverage, and they dismissed mounting political concerns about wealth inequalities. Central bank chose a risk management corner solution. With the Fed now considering to pause despite still high core inflation, the question is if we are seeing, because of concern about the banking system, the question is whether those of us who warned about financial sector dominance are seeing our fears materializing. What's next? What will fiscal dominance be next? You will not be surprised that I believe that central banks are underestimating the continued inflationary pressures and the risk of entrenched high inflation, and this at a time when geopolitics threaten to cause a reversal of some of the structural factors that have helped to bear down on inflation. This, in my view, is not the time to pause. But my main concern is with the euro area. Whereas the Fed, I'm afraid, has shown sign of market capture, the ECB has been hamstrung by North-South fragmentation and concerns about the implications for the South, not least Italy, of strong monetary tightening. This is why the ECB was even slower than the Fed in abandoning its highly accommodating monetary stance. And this is why the Governing Council began tightening only after it agreed to provide targeted support of vulnerable countries through its so-called flexible approach to reinvestment of maturing bonds and through its new transition protection instrument. The actual support under these facilities has actually been limited, but so far, except the first few months, but what really matters here is not the actual support, but the ECB signal that its willingness to provide such targeted support if needed. You will say that providing such support of a sovereign in distress is a responsibility of any central bank. But, as we are all painfully aware, the unique feature of the euro area is that it's not a political union, and it's not making any meaningful progress towards becoming a political union, or towards enforcing fiscal rules, not to speak about promoting the reforms needed to reduce the North-South structural fragmentation. In other words, there's no mechanism for preventing the moral hazard problems that are inherent to a currency union that is not a political union. Take the case of Spain. Spain entered the global financial crisis / euro crisis with debt at 35% of GDP. During that crisis, debt increased to 100% of GDP, as it allowed automatic stabilizers to work, etc. During the subsequent 6-7 years of very robust recovery after the crisis, it did nothing to bring down debt and entered the COVID crisis with debt unchanged at about 100% of GDP. Other countries like Italy and France similarly entered the COVID-19 crisis with debt at the highly elevated levels with which they had exited the euro crisis. Not surprisingly, therefore, the euro area only avoided another existential crisis during the COVID-19 because of large north-south transfers that will be politically difficult to repeat without the compelling humanitarian case provided by the pandemic. This is, of course, why the targeted support is now being provided by the ECB. In a currency union that is not a political union and it has no effective powers for affecting policies at the national level, this amounts to a quasi-fiscal operation on part of the ECB. Importantly, in this regard, both the COVID-related fiscal transfers and the ECB's targeted support is being provided without even attempting the conditionality that during the Euro crisis were aimed at reducing North-South fragmentation, like labor market reforms and pension reforms. The ECB's support is being loosely linked to the Commission's supervision of policies, including the condition attached to the next generation EU disbursement. But measures to mitigate the climate crisis or advance digitalization clearly are extremely important. They will have little, if any, impact on the North-South structural gaps. The decision not to link support to, say, labor market or pension reform is not surprising, as the reforms attempted during the Euro crisis lacked broad political support. They had no political legitimacy in existing treaties. Indeed, the Commission has been powerless following the crisis in preventing Greece, Italy, and now Spain from reversing important reforms implemented during the Euro crisis. It is certainly not surprising in this situation that the ECB has not invoked the OMT. But how long can the ECB keep providing such quasi-fiscal support? Personally, I am absolutely not concerned about the current cycle. A whole host of geopolitical challenges mean that European leaders will have little appetite for another euro area crisis at this juncture. My concern is with the ability to deal with future shocks. Coming back to where I began, the euro was born and started life during the benign period when globalization and other structural changes produced strong downward pressure on prices, allowing a highly accommodative monetary stance. Geopolitics suggests that these structural factors will now at least partially begin to reverse, providing a much more difficult environment for monetary policy and for the ECB looking into the future. And this, as we know, comes at a time when new spending on climate-related measures and defense will strain the situation in high-debt countries with limited fiscal brace. To conclude, it is striking to me, listening here today and yesterday, how we have been discussing fiscal and monetary policy in the euro area as if it was a political union. It is not. So, to avoid another existential crisis somewhere down the road, looking beyond the current situation, we will need to see improved national economic policies and political changes at the European level on a scale that goes dramatically beyond anything that we have seen so far. Changes that are, frankly, nowhere in sight. Okay, I hope the panelists will comment on some of these things. Let's start. I will go alphabetically. David, are you going to start?
I'm always the last one. Yeah. You can respond to this, please, because I have prepared notes.
This. How do I click?
Thank you. Good afternoon, everyone. Gosh, I feel depressed. Yeah, that was. I think I'm going to provide you with a little bit of a cheerier interpretation, at least with the U.S. experience. But first of all, I'd like to thank the organizers profoundly for putting me on the program and for permitting me to join in this conference, which I think is just amazing, in a jewel of a city as well. I don't know how you kept it as a secret from me for so many years, but I'm delighted to be here. So I was asked to comment from the perspective of the U.S. I was at the Federal Reserve of Bank of St. Louis from 2009 to just earlier this year. You know, the Fed, as many central banks, came under a great deal of criticism, great deal of pressure concerning the inflationary burst of inflation during and subsequent to the pandemic. You know, we're accused of moving too late, of many of the criticisms that Poul just noted. Were repeated often, and I thought I would just, you know, sit back and kind of reflect on the experience. I wanted to, you know, and provide a bit of a different interpretation. I think, from kind of more conventional interpretations, and I'll see what you think. So, I think the first thing to understand is the nature of the shocks that hit the economy. I mean, we were hit by big shocks. I mean, many people have pointed this out. These were significant shocks. This is, we had the global pandemic, of course. Millions of people died. We had massive sectoral reallocations. the supply chain disruptions, the global supply chains. We had the behavioral and organizational responses to these shocks that, at least in the United States and I think elsewhere, show no signs of abating. So these are very, very profound and persistent shocks. And just as the pandemic kind of showed there was a glimmer of a light at the end of the tunnel, we had the outbreak of the Russian-Ukraine war that, of course, brought its own set of miseries to the combatants and people of Europe, misery, and, of course, for the global economy, energy price, commodity price spikes that contributed massively to inflation experience. And then in terms of future geopolitical risk, I guess, as if that wasn't enough, we see this emerging Sino-American proxy war that I think is quite likely to get worse before it gets better. So a lot of very, very real shocks. And I guess, from the narrow perspective of monetary and fiscal policy, kind of how do we imagine an optimal monetary fiscal policy to have reacted to these types of shocks? This is going to be my talk. So the first thing to realize is that this shock was not like the financial crisis shock that was still very vivid in our memories at the Fed. That shock was very much just fabricated in the financial sector. It was balance sheets, this numbers. It was not really a real shock. It was a negative aggregate demand shock that had some aggregate supply implications, of course, but it was a very different animal. And I think it was critical to understand that, and I'm afraid it wasn't fully understood, actually, at the onset of the pandemic shock. Among other things, the pandemic shock, induced a massive contraction in employment and output that was, in some sense, voluntary. At the St. Louis Fed, we were trying to explain to people that this is very, very different than the involuntary unemployment that was induced by the financial crisis. This was an episode where we were actually, in some sense, asking people to stay home. We were very concerned at the time about flattening the curve, of making sure that the ICUs weren't overwhelmed. We had no information about the vaccines. We had very little understanding of the nature of the virus itself. And we were basically conscripting large portions of the economy to kind of stay at home, and some had to stay home because people were afraid to go out to contract the virus. The interpretation that we preferred at the time was could be best interpreted as an investment in public health. It's a very, very different type of shock from the financial crisis of 2008 and 2009. And of course, as part of this investment in public health, naturally some sectors were hit harder than others. Leisure and hospitality, for example, just got crushed. I mean, people didn't want to go to restaurants, people didn't want to fly, casinos, hotels, you name it. So essentially, a large fraction of the workforce was basically asked or compelled to stay at home, or the investment in public health, while others, like myself, for example, my colleagues, were able to work from home. And of course, small businesses got hit harder than large businesses. The poor get hit harder than the rich. This happens every time you have any type of shock. In many ways, this was similar to a big war shock that Hall and Sargent have pointed out to, and I thank Ricardo Lago for mentioning this to me. In the wartime, we basically conscripted a large part of the population and sent them overseas. In this war, we conscripted a large fraction of the workforce and asked them to stay at home as kind of an investment in public health. It's kind of the analog. What was needed? What type of fiscal and monetary policies would you recommend for an economy that's hit by these types of shocks? I think it's very clear the first thing you want to make sure is the financial system is on sound footing. So you want to make sure that the central bank stands ready to lend financial support to mitigate the excessive fear perhaps that people might have. People are very afraid of what might happen. So you definitely want financial stability measures. The second thing I think you'd want is some form of social insurance. you do not want economic stimulus, I would say. And this is the part where I think it's important to understand that this was not like a financial, the aggregate demand shock of the financial crisis. We actually wanted to, in some sense, we wanted output to contract. We wanted employment to contract. And the idea of stimulating the economy when you're wanting it to contract seems incongruent. So you want social insurance for sure. As I mentioned, the ill effects of the shock were disproportionately felt. We did not want to repeat what happened during the recovery dynamic of the last crisis, where the perception was that the financial system got bailed out, but the American homeowner was essentially left to flail in the foreclosure winds at the time. It was just not good. It's not good along many dimensions. It's not right, I don't think, but it also wasn't good very politically because it fostered this, it contributed to this political polarization in the United States. So what do you need? I mean, what type of policies would be called for if this type of redistribution, this social insurance, this helping our fellow citizens, if it's desirable? I mean, it seems clear you'd want a targeted, well-designed targeted transfer program that would target, those individuals and businesses that were most ill affected by the shock. And then there's the question of how would you finance such a redistribution, especially in light of contracting output. And the answer there is, well, I mean, there's probably several ways you can think about financing these desired transfers. One way might have been a temporary surtax, like a VAT, for example, that was elevated for a temporary period of time to help finance the endeavor that society judged to be desirable. What did we get in the United States, at least? Well, what we got was we got the financial stability measures that are kind of essential. At the Fed, I was very, I gave the Fed A+ on this. Grade A marks. I mean, my view, many of the emergency lending facilities we set up were not even used. Just the mere establishment of the facility seemed enough to calm nerves in private bond markets, for example. So I give the Fed A+ along that dimension. What did we get in terms of social insurance? Well, we got the two really big fiscal packages was the CARES Act under the previous administration, and then the American Rescue Plan under the current administration. These transfers were largely targeted to the bottom half of the distribution. I didn't receive any money. I got to work from home. I was very fortunate. The money basically went where it was supposed to go broadly. You had the PPP loans that were designed to support small businesses, but that basically did what it was supposed to do as well, in my view. Now, the implementation was sloppy. There's a considerable amount of fraud as well, as you might expect when these packages are put together and it's a war. I mean, you don't have time to fine-tune these things. And also, we were very cognizant of kind of underdoing it at the previous crisis. And if you underdo it, you're going to have to live with the political consequences for a long time. So it was viewed that overdoing it, if anything, was the way to go. But this was known beforehand. This is, and then how was it financed? Well, we don't have a VAT in the United States, and in any case, it would probably have been politically infeasible to actually finance it in that way in the short time that was needed to pass the legislation. So the way we financed it was, really through the inflation tax. I mean, you gotta finance it some way. If these transfers are desirable and necessary, which I argue most people would have argued yes, you gotta finance it some way. If not a direct tax, it's gotta be some other tax. So I have a very, very different view about the desirability of the inflation that we've experienced. I actually interpret it as a constrained second best public finance measure. And that any attempt to fight that tax from emerging would have had much, much worse consequences for what happened. So I think we really need to give a pause here about how we interpret the inflation that we've recently experienced. On the other hand, even at the Fed at the time, I was not in favor of cutting interest rates. I was in line with Michael Woodford, who wrote a paper at the time saying this type of shock does not require a cut in interest rates. This is not a time to stimulate demand. This is a time for social insurance, and the CARES Act at the time was doing that. And so I give the Fed an F on this dimension. So there you go. Even at the Fed, I was praising it and also criticizing it at the same time. So this was an unneeded measure, and I think it primarily manifested itself, I'd say, in elevated asset prices that have subsequently been reversed. Here's the inflation experience in the United States. This is PCE inflation, the official headline measure that the Fed uses. The orange line is the month-over-month annualized inflation rate. The blue line is the year-over-year measure. You see this, basically, the year-over-year measure is basically nicely hump-shaped. I'd argue that if you were to actually run an optimal public finance simulation in a real business cycle model, that was designed, you wanted to finance, say, an optimal transfer policy through a VAT, that the optimal tax would have likely looked something like this. Consumers would have been complaining about the increase in cost of living, the taxes are higher, they're making the goods more expensive, but at the same time, there's no free lunch. You have to finance the endeavor in some manner, whether it's a direct tax or inflation. It happened through the inflation tax in the United States. Was the inflation avoidable? Yes, of course it was avoidable. Of course it was avoidable. But think about the types of policies that would have been necessary to avoid the inflation, and then think about how these very real shocks would have had to manifest themselves. It's not like there's a free lunch here. If you would have kept inflation stable, I mean, it's quite likely, I think, that you would have seen unemployment spike up very high and remain high for a very, very long time. And then people would be complaining about the ill state of the labor market, et cetera. So here's the inflation unemployment rate experience for the United States since the last crisis. We see that, in the last crisis, the unemployment rate remained elevated and came down very, very slowly. It was painfully slow recovery. And again, this was in response to a completely fabricated shock in the financial sector. There was no real shock at the time. Take a look at the spike in unemployment in March of 2020. I'm telling you, I think most of you know, I mean, if you're sitting there in March of 2020 and you were to ask most Americans whether they would take this recovery dynamic with the cost of this bump in inflation, my guess is most Americans would have taken it. I mean, this is borderline miraculous recovery as far as I'm concerned. And the inflation, yeah, of course there was a cost, but somebody had to bear the cost of these very real shocks, and this is the higher inflation was just one way that it was born. In terms of, let's see, I'll move on cognizant of time here. In terms of the debt to GDP ratio, I think I was happy to see Lucas, I think, plotted the same thing, the blue line there. The orange line is the conventional measure of debt to GDP. We see that it was stable at about 100 prior to the shocks. It was elevated substantially. It has subsequently come down a little bit, primarily because of the inflation, and in part because of the real recovery. I'd like to look at the blue line, and Lucas did this as well. This is the market value of marketable treasury securities as a ratio of GDP. The difference here is the marketable, the total debt overstates the debt because much of this debt is held by intragovernmental agencies, and the marketable debt is primarily that held by the private sector. And we see that the debt to GDP ratio in the blue line is coming down much more rapidly, in part because of the inflation, but also in part because of the higher interest rates. And so the question is, like, if you believe in mean reversion here, you might be asking, like, how much further does inflation have to go up? How much further do interest rates have to come down to kind of make this debt to GDP ratio come back down to kind of its steady state level? Probably not much is what this diagram is suggesting. Okay, let me conclude about the future path of inflation. I think that, first let me comment briefly on Fed policy. I'm still very close with a number of the people there, and my former boss, Jim Bullard, and also Chris Waller, who's at the Board of Governors now. I mean, I mean, this is not private information. This is from their public speeches. They say that as long as inflation remains above target, and as long as the labor market remains okay, I mean, we're going to have to expect further rate increases. This is just what they're saying. The policy will be data dependent, of course. It will depend on how things evolve. But the Fed has a dual mandate, and notwithstanding the recent reverberations in the banking sector, I think by and large, given the way the data looks right now, I'd be expecting further hikes, although probably not as dramatic as what we've seen so far. And then barring any further shocks, I mean, I think I have to admit I was always on team transitory. I still am on team transitory. I think team transitory was largely correct. The energy price shock was a supply shock that was transitory. The fiscal stimulus, at least in the United States, was large, but it basically ended by the end of 2021, and it's just continuing to work its way through the system. So, but I think the big question is not whether inflation is going to continue to come down. I think the big question is, of course, is whether it's going to come back to its 2% target anytime soon. And here, I think it's very hard to say. I don't think any of us can say. My own view, I take a very fiscalist approach to inflation, to the determination of long-run inflation. And to me, fiscal policy is what's critical here. Fiscal policy, though, depends on unfolding geopolitical events. And the growing Sino-American conflict here is a pretty worrying sign. These wars, whether they're hot wars or cold wars, put fiscal pressures on governments, in the United States in particular. And these fiscal pressures are going to be inflationary pressures. And there's even the question of whether it's desirable to let inflation come down to 2%, because maybe a little inflation tax is not a bad way to help finance the global policeman role of the United States. It's our allies that are using our treasuries extensively for a variety of reasons, perhaps are chipping in a little bit here as well through this slightly higher inflation tax. I don't know, but that's where I'll end it. Thank you very much for your attention.
No presentation. Okay. That's the next one. Good afternoon, everybody. Can I just start by also thanking Boris and the organisers for inviting me to this conference and for hosting this conference in this venue. My first visit to Croatia and my first visit, obviously, to Dubrovnik. Delighted to be here, and thank you both David and to Poul for their comments, and I look forward to the discussion that we're going to have afterwards. My focus is going to be on the interaction between monetary and fiscal policy. And I suppose it's a bit of a truism to say that the current macroeconomic environment is a complex one for policymakers. The outlook for inflation continues to be too high, and we're continuing to project it to stay too high for too long, which means there is more ground for central banks to cover. Monetary policy must be brought to levels sufficiently restrictive to bring inflation back to target, and as Philip told us yesterday, in a timely manner. But fiscal policy must also adjust its priorities to tackle the challenges of the major economic transitions involved in climate change, in aging populations, and in geo-economic fragmentation. But the increased cost of living does generate political pressures that could slow this necessary adjustment. As I think most of you know, monetary policy fights inflation mainly through two channels. First, by reducing aggregate demand, and second, by anchoring the expectation of future inflation to its target. And at times like this, when inflation is already far too high, expansive fiscal policy risks undermining both of these mechanisms. primarily by increasing aggregate demand, but also by signaling that the government is counteracting the effects of policies aimed at reducing inflation, potentially increasing inflation expectations. And that's why I and others have previously called for cost of living supports to be targeted, to be temporary, and to be tailored. Fiscal policy can be a major force for good when it provides a stable foundation for a thriving economy, but it can also cause great harm by adding to inflationary pressures, which would inevitably call for an even stronger monetary policy response. Monetary and fiscal policies need to work together to shore up macroeconomic stability. And the coherence of monetary and fiscal policy is essential for that stability. During the pandemic, we saw how powerfully combined monetary and fiscal efforts helped our economies to quickly get out of recession. But it is also not only during downturns that monetary and fiscal policy need to coordinate their actions to effectively complement each other. An adequate policy mix is just as essential at times like this when we must fight inflation. At a minimum, fiscal policy should avoid directly contributing to the building up of inflationary pressures, but preferably fiscal authorities should support the disinflation effort by gradually bringing down high public debt while also calibrating their policies to make our economy more productive and to avoid adverse distributional effects. Monetary policy cannot be targeted and tailored in the way that fiscal policy can, nor does it have the mandate to address those distributional issues. But monetary tightening could be complemented with changes in the composition of fiscal spending, where the available resources are better targeted to those most in need of support. Inflation imposes a burden on the poorest households disproportionately, and in the short term, monetary tightening may add to this burden by constraining aggregate demand and labour market conditions. And a better composition of fiscal spending is essential to protect the economy from the risk of poverty and excessive income inequality. The fiscal policies that we are seeing in action are not sufficiently adhering to these principles. In the euro area, the fiscal response to the energy crisis has been large, amounting to nearly 2% of GDP in 2022, with similar figure expected in 2023. And while difficult to classify precisely, about half of the total support in the euro area over the 22-23 period is assessed as affecting prices directly via lower marginal cost of energy consumption, with income measures making up the remainder. Only about 12% of the total support is estimated to be targeted at vulnerable households, and to a smaller extent firms directly affected by higher energy prices. And such untargeted spending is increasing demand and directly contributing to inflationary pressures. Price measures and energy price discounts may have contained prices initially, but they are costly to the budget and prevent often necessary demand adjustments. Most importantly, by contributing to higher and more persistent inflation over the medium term, their longer-term effectiveness is questionable at best. The outlook for public finances can rapidly change. Monetary tightening has not yet adversely affected public debt sustainability, which is largely due to the initial positive impact that inflation tends to have on the public finances. But together with higher revenues, a rise in nominal GDP, owing in large part to high inflation, has led to significant decreases in the debt to GDP ratio that had reached historically high levels after the pandemic. Deficits, however, continue to be too high. In the fourth quarter of 2022, the deficit to GDP ratio stood at 4.7% in the euro area. It grew compared to the previous quarter because increases in total expenditure exceeded those in total revenue, which shows that the initial positive effects of inflation on public finances can easily revert over time. Spending measures can intensify, offsetting or even overtaking the benefits on the revenue side. So far, while government bond yields are obviously rising in response to policy rate increases, sovereign spreads have remained relatively compressed. However, with growth expected to reduce, government interest payments increase, and the central bank progress in its quantitative tightening, the sustainability of public debt cannot be taken for granted. The least desirable scenario is one in which markets start questioning sovereigns' creditworthiness again. In Europe, we know only too well the financial distress that can result in such cases, and the deep and long-lasting scars it can leave to the economy. Sound management of public finances, firmly based on counter-cyclicality, debt sustainability, and the promotion of growth can help avoid adverse outcomes like this in the future. We should also not underestimate the damage such episodes do to trust in the euro itself. Appropriate governance could help to put public finances on a sound and long-term footing and reduce the tensions between fiscal and monetary policies. These tensions are not new. Even in the short history of the euro area, our macroeconomic performance has suffered from fiscal pro-cyclicality as well as from episodes of fiscal sustainability problems in some countries. Sustainable fiscal positions and counter-cyclical fiscal policy are necessary conditions for the realization of price stability and macroeconomic stability. And yet the macroeconomic governance framework that was in place over the first 2 decades of the euro proved insufficient to promote them. The importance of making the framework a better fit for the task cannot be overemphasized. And I believe that the European Commission's views, which were released late last year, correctly identify the key elements of the reform in improving national ownership, simplifying the framework, and moving towards a greater medium-term focus combined with stronger and more coherent enforcement. If the new framework is able to implement these principles effectively, greater transparency and credibility, together with an improved enforcement mechanism, could drastically improve fiscal discipline and provide for a more solid anchor for public debt sustainability. It is, and you won't be surprised to hear me say, both appropriate and desirable that the ECB takes the lead in fighting inflation. We're seeing the impact of our tightening in the first stage of the transmission. In recent months, the Governing Council has articulated how it will operationalise the path ahead for interest rates. And looking ahead to June, our next round of projections will be a useful input in determining the policy prescriptions. And as you heard from Philip yesterday, they're going to be complemented by 3 further and important inputs: incoming economic and financial data, the dynamics of underlying inflation, and an assessment of the strength of transmission. Monetary policy affects the economy with long and varied lags, and the full effects of our tightening are still likely ahead of us. In saying that, however, and given our current outlook for inflation, we are likely to be close to the top of the ladder. So slowing the pace to standard rate steps is appropriate. The calibration of monetary policy from here has to remain data dependent given prevailing uncertainties. But what is certain is our commitment to price stability. Bringing inflation back to its 2% target in the medium term will lay the foundations for a strong euro area economy. Fiscal policy can and should help by avoiding boosting net demand, holding back supply, or raising prices, and of course by supporting structural reform to meet the challenge of the economic transitions that the European economy is facing. Thanks very much.
Perfect. Yes, thank you.
Just a sec.
Perfect, thank you. Let me also start with congratulations to the National Croatian Bank for joining the euro, and of course warm thanks to to Boris, to Tomislav, to everybody here for having me over in this marvelous place again. Last time I came was over a decade ago, and yeah, times have changed, but it's wonderful to see so many old friends here. In my remarks, I'm going to reflect a bit on themes that, of course, echo what what has been said so far, but also echo a bit the live perspective I had when I was in charge of the World Economic Outlook at the IMF and doing our first forecast of growth in 2020 when COVID was starting. I think the point is a very basic one, but it's a little bit forgotten in a lot of the discussion on what, the mistakes that policymakers did. So this was a period clearly of policymaking under extreme uncertainty. Of course, the main one is the main cause, the COVID pandemic, but of course the war in the Ukraine as well. And really the range of outcomes was incredibly broad. And it was incredibly broad because we had to track not just the potential economic consequences of a virtually unprecedented shock, but track those consequences through possible very different epidemiological scenarios. So complexity much beyond the traditional issues that we face, and we face, say, during the global financial crisis, when we had to deal with a purely economic shock. And I think that some of the lessons of the global financial crisis were well learned. There was an appropriately large policy response in AEs. I think it is perfectly reasonable to discuss ex post and to reflect on what mistakes were made, what is the best way, what lessons should we take from the experience. But I think it's also important not to lose sight of the fact that you had this massive uncertainty and that you were not on a certainty path leading the way we actually went. There was a lot of fear we would get stuck with scarring, with very persistent unemployment, with loss of human and physical capital extending much beyond a short-term horizon. And we did not forecast such a rapid recovery from COVID. What is striking, if I look back at the experience in trying to forecast this at the IMF, was that we actually got the 2020 forecast about right, which is sort of miraculous, but it's purely, we were right for the wrong reasons. Fundamentally, had we had a forecast conditional on the fact that we would have repeated waves of COVID extending way beyond late 2020 and the beginning of 2021, we would have been incredibly more pessimistic. So I know it's a bit of a lengthy background, but I think it's useful to keep that very firmly in mind when we assess policies that were decided under that fog at the time. Now, we do have a set of challenges inherited from pre-COVID trends and from the crisis that on the fiscal front are daunting. I mean, we have, despite the erosion of public debt due to inflation, because of the size of the policy response and because in most countries we are below pre-COVID trends in terms of GDP, public debt is higher. In addition, we have a set of larger expenditure demands, not really forecastable, or at least not all of them, in a pre-COVID world. The energy transition was more forecastable, but the increase, I'm talking here mostly about advanced economies, particular eye on Europe, increased military spending was certainly not something in the cards, nor was the cushioning of the extreme energy shocks that Europe has faced. And I think we should not also underestimate the health sector considerations. Think back of the global financial crisis and the whole debate surrounding the financial reforms needed to avoid a repeat of that type of shock. Clearly, this health shock exposed a lot of weaknesses, a lot of vulnerabilities in our health systems, and it is another potential source of additional demand on resources, which is clearly, in principle, extremely reasonable. And the last one, of course, debt service. Should, interest rates turn positive in real terms, persist over a longer period of time. I would say, from the point of view of the EU, clearly one positive aspect I see is a more favorable cooperation regime. I think the NGEU funds, both in practice but also as a principle, are something that is really a watershed moment in European cooperation, and possibly together with the fact of the perceived common challenge posed by the war in the Ukraine, is something that has brought European policymakers more together than we were used to. Now, what about the concern with inflation proving more persistent than anticipated? Again, one general observation I would make is that it is very hard to design a reasonable policy counterfactual where inflation would have been systematically, consistently lower than what we have observed. This is, again, not to say that interest rates in the US shouldn't have gone up 6 months before, for instance, but the lion's share of what we have seen is the result of a series of virtually unprecedented shocks and I would say, in good part, needed policy response to cushion their impact. But I think, again, there's a bit of a tendency to lump together the Europe and the US alongside all fronts, and I think there are very important differences to be considered. Clearly, the US had a much bigger fiscal stimulus overall. The state of the labor market was different to start with. But very importantly, the size of the energy shock is massively larger in Europe, and it is a very asymmetric shock in the sense that not just that the dependence on imported energy is different, but also because gas prices have moved to very different extents across continents. And clearly, Europe has suffered a very large terms of trade shock, which the US did not suffer from, and that has important implications, including for the impact on inflation on public debt. In Europe, the GDP deflators are not going up at the same pace as CPI. In the US, you have, of course, more alignment because the terms of trade, if anything, have improved. Do I worry about more persistent inflation? I'm more in the dovish camp in terms of fear that inflation will become entrenched, but it is clearly possible that, especially in the US, inflation may prove more stubborn, more difficult to bring down. And I was struck by the extent of certainty with which markets were pricing in interest rate cuts pretty soon in the United States. This appears to have shifted particularly with the latest data releases on both retail sales and the PCE. I think my main concern lies with the risk for heightened financial stability vulnerabilities and the potential for a risk-off environment, rather than the potential to settle in for a long period of uncomfortably high inflation. And I fear for that because of the list of fiscal vulnerabilities or fiscal pressures that I listed earlier on. Clearly, spreads are still quite contained, but in a setting in which interest rates surprise on the upside, the likelihood that the pricing of longer-term assets, that the behavior of spreads will be different, the risk is a non-trivial one. And I think central banks tread a fine balance between the speeding up this inflation and causing a large slowdown. I think I'm not a central banker. I fully realize that one has to talk the talk at this time. Inflation is uncomfortably high, but of course GDP risks are non-trivial ones to be considered, also because we know that the concerns about public debt and financial stability are very much correlated with the outlook for growth. Let me stop here, and happy to take questions at a later stage. Thank you.
Good afternoon, everybody. Thank you for the invitation. Thank you, Boris. Boris has disappeared, so anyway, someone will pass him the message. I'm the last one, so about everything has already been said once or twice, which puts me in a difficult situation. Let me try to recap on some of the messages. So I think the easy answer to the policy mix going forward on monetary policy, we've got some more grounds to cover. I will not say more about it because Gabriel and Philippe brought you the message. On fiscal, of course, we would hope and expect some consolidation. And we know that there is a tendency in Europe, especially for fiscal policy, not to be pro-cyclical all the time, but to be pro-cyclical in the recovery. That's what Poul alluded to. We miss the recovery, what needs to be done during the recovery. And of course, the risk of that, that Gabriel mentioned, is that if fiscal remains supportive, then monetary policy will have to do more to get inflation under control. This is going to imply higher interest rates and, at the end of the day, over the medium term, higher deficits because of that burden and a higher risk of fiscal dominance. Now, just to mention it, what is the impact of inflation on the fiscal balance and debt? And again, Gabriel did mention it, but positive short term, I mean, the real value of debt is going down, so it's recreating some fiscal room, but we know that the impact down the line is going to be negative because of higher real interest rates. So this actually reinforces and risk increasing the procyclicality of fiscal policy in Europe. So now let me basically take a step back and maybe revisit what we used to consider as our framework, but that has not always been, I think, completely in line with practice over the last decades. So when we created the euro and we thought about the institution of the euro and the ECB, we were in the 90s, and it was a time of clear separation between fiscal and monetary policy. But as I just mentioned, it's like in the early days of Facebook, you had this category where you had to mention, married or not married or whatever, and then there was a category, it's more complicated. And it is more complicated. So it's a long way back, but when we were stuck with low inflation, we started at the end of the period to have a number of people saying, okay, we need fiscal support to bring inflation back to 2%. So away from this separation principle that essentially fiscal policy should deal with, microeconomic issues, redistribution, public policies, and that the cycle should be the responsibility of monetary policy relying on the divine coincidence most of the time. So we had a few papers saying that, and with quite sophisticated commitment technologies, that fiscal policy should aim at helping monetary policy go back to 2%. I was not a big fan, but just to mention it. Then we had COVID. And I fully agree with Gabriel and others, and Gian Maria. I think what we did was necessary, but I also agree with the point that was made that actually monetary policy in it by itself was not very efficient because people were stuck at home. So, you know, reducing interest rates was not going to increase investments in households' investments or firms' investments. So monetary policy was effective by allowing for a credible fiscal response. And it had a side effect of having an impact on financial markets and increasing asset prices, which probably was not really necessary. But I still believe, you know, no regret that we did what we had to do. And then we had a stronger recovery, and it came faster than we thought. And yes, we were late in reacting, mostly because we thought that inflation would be transitory and that core inflation would go down quite fast. And plainly, we were wrong. And we overestimated the capacity of the models that had been calibrated over a long period of low inflation to tell us really something very meaningful about how persistent inflation would be. Would have it made a big difference if we had reacted faster? I'm not so sure. I mean, in this part of the world, central banks did increase interest rates before we did at the ECB, and they were still faced with high and persistent inflation. And honestly, I mean, we've been doing some catching up over the last year, and I think we are now well positioned to deal with inflation. So let me go back to monetary and fiscal interaction and the fact that they are conflicting today. They are going in different directions. Of course, we hope it's going to change and that there will be fiscal consolidation. I'm a bit less hopeful about the new European rules and governance. And basically, it's, you know, they are going to be pragmatic, which can be anything. So I don't know. It could be good. It can be too little. It can be too much. I do expect some fiscal consolidation on average in Europe. But the problem, it's not only about the average. It's also about all countries in the EU that have high deficit and debts doing what they have to do. And there I'm much less optimistic that we are not going to be faced with some kinds of risk of fragmentation. And basically some countries having fiscal policies that are not really sustainable. And honestly, the country I know best is one case in point. So let me also maybe take another step back and look at a more structural level of interaction, which I think is a real issue, and I really don't know conceptually how we need to deal with. By having to act forcefully during the financial crisis, during the COVID crisis, we have contributed to a feeling among our citizens, the population, that you know, with these long periods of easy money, that when there is a problem, fiscal policy is going to take care of it with the support of monetary policy. And of course, we know that we could do that because inflation was low. But, you know, people don't know that. And they say, okay, you've saved the banks, you've saved the economy so many times, you now want to deal with climate. So if there is any problem that I'm being faced with, I expect to be compensated. And we have contributed to that narrative, to that political reality. Again, I don't know conceptually how we should deal with that, but it's a problem, and we are and have been part of that problem. And honestly, I mean, I've been talking when rates were low, and they are still quite low in real terms. I've been talking to quite a lot of politicians, ministers, and even ministers of budget and finance in Belgium, and we've got many of them. And they were just plainly telling me, as long as rates are low, we are not going to do anything in terms of fiscal consolidation. It's as clear and as plain as that. So, of course, the treaty, Maastricht, foresees that monetary policy should be able to operate far away from any form of fiscal dominance. So I'm not saying we are now under fiscal dominance. I don't think so. I mean, we've hiked 400 basis points, and we might have to do more. So this is not fiscal dominance. I'm not saying that. But what I'm saying is that, you know, we felt more comfortable first doing the TPI. We've got PEF flexibility. We know that there is a risk that in some countries the fiscal situation is maybe not going to improve enough. So what I would say is that we've been flirting, and we are flirting with some weak form of fiscal dominance. We are not in the situation that have been foreseen by the treaty, where we could operate in terms of monetary policy completely without thinking about the fiscal implications. This is not okay, and this is again one more argument for why fiscal positions need to be improved in all countries that have high debt and deficit levels. And then again, we've got these new rules that are actually not in force, but that everybody talks about. I hope that they will recreate this room that we need to not think about fiscal policy anymore when we conduct monetary policy. And I will stop there.